I remember sitting at my desk watching a number go down, not by a little, by a lot. And the worst part wasn't the money, it was the realization that I have done it to myself. I had made decisions that if someone had just sat me down and explained a few basic things, I would never have made. But nobody did, and I wasted years and real money finding out the hard way. So that's what this video is. It's the conversation I wish someone had had with me. 4 mistakes I made when I started investing, what they actually cost me, and exactly how to avoid them. If you are just getting started or you have been putting it off because the whole thing feels overwhelming, this one's for you. Quick bit of context. I have started my investing journey in 2018. I didn't grow up in a household where we talked about money. My parents worked manual labor jobs and got by. But ISAs and index funds and compound interest weren't exactly dinner table conversation. So when I eventually started earning a bit and thought, right, I should probably do something with this, I had no idea where to begin. I did what most people do. I googled, I went down the YouTube rabbit holes. I read forum threads at midnight, and in doing all that, I made every single mistake I'm about to show you. I'm not sharing this to be self-deprecating. I'm sharing this because if you can avoid these 4 things, you will be years ahead of where I was, and that's worth something. Right, let's get into it. Mistake number 1, chasing the hype. The first mistake, and honestly the most embarrassing one to admit, it was around 2020. You couldn't open a news app without seeing a particular tech stock plastered everywhere. Everyone was talking about it, people online were posting their gains like they had cracked some secret code. And I thought I need to get in on this. I didn't understand what the company actually did. Not really. I hadn't looked at their financials, I just knew the numbers had been going up and I had the fear of missing out absolutely eating me alive. So I put a chunk of money in, and for a little while I felt like a genius, and then it didn't. Here's the thing nobody is telling you when you're starting out. Picking individual stocks isn't investing, it's speculation. And it's speculation you are doing against professional fund managers with team of analysts, decade of experience, and tools you and I will never have access to. The odds are not in your favor. Stop trying to find the one stock that's going to 10x. Instead, own all of them. That's what a global index fund does. When you invest in something like FTSE All World Index Fund, you are not betting on one company. You are betting on a tiny slice of thousands of companies across the world. Some will fail, some will absolutely fly, but historically across the entire basket they will go up. You are not trying to be clever, you are trying to capture the growth of global economy over time. And that is a bet that has paid off consistently for a long period of time. Funds like Vanguard FTSE All World or equivalents on platforms like InvestEngine are exactly the kind of thing I am talking about. One fund, thousands of companies, dead simple. Don't find the needle, own the haystack. Mistake number 2 is ignoring the tax wrapper. This one is particularly painful because it's not dramatic. There is no crash, no panic moment, you just genuinely give away money that you didn't have to. When I started out, I opened a standard trading account, felt very grown up, bought some shares, didn't think twice about where I was holding them. What I didn't understand was that outside of a tax wrapper, HMRC has a claim on your gains, your dividends, your profits. Every year you're growing your wealth. The government is entitled to a cut unless you use the tools they have specifically created to protect you from that. The FIX, the Stocks and Shares ISA. Every adult in the UK gets a £20,000 ISA allowance each tax year. Money that goes in grows completely tax-free. No capital gains tax on your profits. No income tax on your dividends. Nothing. You keep every penny of your returns. Think of it less like a product and more like a wrapper. A legal shield you put around your investments so the taxman cannot touch the growth. If you are investing outside of an ISA right now, the very first thing you should do after this video is look at how to move that across. Most platforms, Vanguard, InvestEngine, Hargreaves Langston, Fidelity, all offer stocks and shares ISAs. You have already earned that money. Don't give more of it away than you have to. Mistake number 3, waiting for the perfect time. Right, this one is the one that I think cost people the most. Not in dramatic losses, but in lost time. And time is the one thing that you genuinely cannot get back. After my hype chasing phase, I overcorrected. I became obsessed with timing the market. I would watch financial news every morning, looking at the signs. Is there going to be a crash? Should I wait for a dip? Surely it can't keep going up. I will wait until it comes down a bit. Months passed, then a year, then longer, and the market, it just kept going. and I was sat on the sidelines watching it happen, fully convinced I was being smart. There is a famous study, I'll keep this brief because the data is genuinely striking, and that looked at what would happen if you missed just 10 best days of the stock market over a 20-year period. Just 10 days, your returns were cut by more than half. The problem is you don't know when those days are coming. Nobody does. They often come right in the middle of periods of maximum fear. Right when every instinct is telling you to wait. The fix? The answer isn't to be reckless, it's to be consistent. Regular automated contributions, even small ones, into a diversified fund every single month, regardless of what the market is doing. This is called pound cost averaging. Some months you'll buy when it's expensive, some months you will buy when it's cheap, but you will always be in. And being in is the whole game. Waiting for the perfect moment to invest is like waiting for the perfect moment to start exercising. The perfect moment is now and every month after that. Mistake number 4, checking the app every day. Last one, and I say this with complete awareness because I still catch myself doing it. When I started investing, I checked my portfolio every single day, sometimes multiple times a day. I had the app on my home screen. I would wake up and check it before I had even had a cup of tea. And here's what that did to me. On a good day, I felt like a genius, and on a bad day, which by the way is most of the days, because markets move around constantly on a day-to-day basis, I feel like I had made a terrible mistake. The anxiety was real. The urge to just do something, to sell, to move things around, it was constant. Here is some context. Stock markets are a negative territory on roughly 47% of individual trading days. Nearly half of the time. If you check your portfolio, it looks like something is going wrong. That's not a problem, that's just how markets work. But checking daily means you feel all of that noise without any of the signal. And here is something the platforms won't exactly advertise. The more you engage with the portfolio, the more likely you are to make an emotional decision. These apps are designed to be checked. That doesn't mean checking them is good for your returns. The fix: automate everything you possibly can. Set up a monthly direct debit into your ISA. Set it to automatically invest into your chosen fund. Then put your phone down. You don't need to check it weekly. You barely need to check it monthly. A quarterly review just to confirm everything is aligned with your goals is genuinely enough for most people. The best investors aren't the most active ones. They are the ones who set up a sensible strategy and then had the discipline, or frankly, the forgetfulness to leave it alone. So, 4 mistakes: chasing hype instead of diversifying, ignoring the ISA wrapper and quietly giving money away on tax, waiting for the perfect time instead of just starting, and checking the app daily, letting the noise drive the decision. None of these are complicated. None of them require you to be a financial expert or to have started with a lot of money or to have grown up in a household that talked about this stuff. The biggest hurdle in investing is just starting. Not perfectly, just starting. With whatever you have got inside an ISA into something diversified on a regular schedule and then leaving it alone. That's it. That's the whole thing. I spent years thinking there was some secret framework I was missing, some strategy that clever people knew I didn't. There isn't. People who build wealth from nothing aren't the ones that found a secret hidden trick. They are the ones who started early, stayed consistent, and ignored the noise. You can be one of those people. You are already watching the right videos. If you want to know exactly where investing fits within your broader financial life, what to prioritize first, and how to order it all, I've got a video on the financial order of operation that lays the whole thing out. That's the logical next step from here. It's linked on the screen now. And if this video gave you something useful, subscribe. I make the content for people who didn't have anyone to explain this stuff to them. That's the whole point. Thanks for watching, and I will see you in the next one.